apologize for being late. So we'll start here in a couple minutes. Okay. Okay, so just trying to make sure we have everybody. I think we're still waiting for a couple more. Okay, well, so we'll just get started. I'm sure they'll come in a minute if they're going to come in. Also, if I'm not on time, a minute or two late, don't hesitate to call me at my extension. I apologize. Just I was on a support call trying to help somebody, and I didn't look up. So let's see. The objective of the webinar is to produce an example set of working papers that you can use as a reference in producing your in-house work papers to cover concepts that lend to consistent in-house financial statements. So the reason to have a set of work papers is probably another thing we could talk about. So what would be some of the reasons? And it would be, you know, basically you get questions about your financial statements, your internal financial statements, or even your year-end, and then on your year-end, your CPAs will refer to their work papers. But so the reasons would be basically documentation supporting the amounts on your financial statement, on your internally generated that you can refer to at a later date. Now on the right-hand side of your screen, if you hit the red arrow, which is on the upper left-hand side of that dialog, the GoToMeeting dialog, it'll hide your control panel and give you access to the right-hand side of the screen. So at a later date, so basically to answer questions if someone were to ask you about it. Also, it lends well to the concept of consistency. Okay, so an objective with your internal financial statements would be to produce accurate results, right? And most accurate results are more important to you internally than the results even generated externally. Because if you're to be a viable long-term company, you have to make money, and that's the bottom line. And then external entities want to do business with you as long as your information is reliable. And I practiced in public accounting for 18 years, and there's two different types of concepts out there with respect to the financial statements. Some people would have the concept that the financial statements were something that could get them bonding and could get them banking, lines of credits and things like of that nature. And that concept, is probably universal. Everybody really has that, but some of them would have the idea that maybe if they made them look a little better, they'd get a little better relationship. And I think that's an unsuccessful it's an unsuccessful approach, because you're not only misleading them, but you're misleading yourself. To build strong relationships, you want to be as accurate and consistent as you can possibly be. Also, there's a concept called being conservative on your financial statements. And a conservative financial statement means that you're really going to understate them a little bit, so that, like on your projects, and we'll go through your over-under billings on your projects. If you think you're going to make 10%, maybe put them at 8%. Or if you think you're going to make 30%, put them at 25%. That way, at the end, you've got a little bit of cushion, so that if they were to fade a little bit, you're not going to be showing, you won't in the past have shown better numbers than they really were. And then also, if you gain a little ground at the end, it gives the readers of your financial statement some comfort that you're generally conservative on your numbers. Okay, so how do you produce a quality in-house financial statement? You perform a list of monthly procedures that includes test of balances on your balance sheet accounts and other analytical procedures. So it's basically a checklist that you go through, ensuring consistency, and the quality of the items on the checklist are going to give you, hopefully translate into, a consistent quality financial statement, something that's fair. Okay, so what are tests of balances? And a test of balance is a process of substantiating your balance sheet account balances. So for example, if you have a bank account, a test of balance would be your bank reconciliation, going through that bank reconciliation. So producing the bank reconciliation and reviewing the bank reconciliation would be a test of the balance, because you're really supporting the balance on that bank reconciliation, that bank account. Okay, so that's on your balance sheet accounts. Every one of your balance sheet accounts, as far as assets and liabilities are concerned, are something that you can go to external documents outside of your general ledger and your accounting system, and support those balances. So an accounts payable aging, you've got invoices from suppliers and subs that basically support the balance on your accounts payable aging. Okay, so external documents that can be supporting these items. So you produce a bank reconciliation, even though it's done in the system, it's really external to the general ledger, and you have a bank statement that ties into the bank reconciliation, okay? And then the bank reconciliation ties into the general ledger. So how do you represent that your in-house financials are fair? And you represent it by performing a list of monthly procedures, test balances. Okay, so and you produce a set of working papers. What is this? What is an example of substantiation of a balance sheet account? And we just talked about that, a bank reconciliation on the cash account, tying the bank reconciliation to the monthly bank statement. What is an example of other analytical procedures? Okay, so reviewing the bank's reconciliation for old outstanding checks or deposits in transit. So an old check that's never going to clear the bank, an old check is never going to clear the bank that you would want, and you would want to get that off your bank statement. So I just rewrite that. So okay, so we'd want to get that off the reconciliation. So let's say you've got $5,000 in checks that are, a year old, which is not all that uncommon if you're not trying to clear those off on a regular basis. And so your bank reconciliation, even though it might tie to your bank statement and your general ledger, is really wrong by $5,000, right? So how do you prove that you've done work to ensure that your in-house financial statements are accurate? You produce a set of working papers that can be referred to should questions arise. So I guess we already had that question. Okay. No, we'll just leave it in there. Okay, so so your equity position, the difference between your assets and liabilities. So that's just a definition. So on your balance sheet, you've got basically, let's go into the demo database. Okay, so we have our balance sheet, we have our assets, and we have our liabilities, and the difference between our assets and our liabilities is our equity. Pretty elementary, but some of you don't have accounting background, so we want to just cover that concept. What is a cutoff date? Another fairly elementary concept, but if you're not an accountant, you might not get that. So we'll cover it. The cutoff date is basically the last day of the month or period for which you're producing your financial statements, okay? So what is the significance of a cutoff date? It provides a date that you can use to substantiate your balance sheet account. So it's an objective date. So if I pull my assets together as of one day and my liabilities together as of a different date, I'm not going to have a set of books that tie out. So it gives us an objective date that we can use. You'd always want to do your financial statements, let's say 5 or 10 days after that cutoff date, because you're still going to have transactions that are coming in at that cutoff date that relate to that cutoff date. And for example, accounts payable, we generally use the accounts payable invoice date as our objective standard. So we might, on the second or third, we might get AP invoices that are dated up through the end of the previous month. So it's better to wait a few days or a little while after the end of the month to do the month-end financials. Okay, so period versus cutoff date. So a balance sheet is as of a cutoff date. An income statement is a running total of amounts, or an income statement is a running total of amounts from the beginning of your fiscal year through the cutoff date. So that's your period. So the balance sheet doesn't really deal with the period. It just deals with the ending date. The income statement deals with a period from the beginning of your fiscal year through the cutoff date. And on your income statement, you can also run it for a month or a week or however you want to do that. Those two columns, and it can be multiple periods. But we're generally also doing the year-to-date numbers. A balance sheet account has a balance that you can that can be substantiated as of a cutoff date, and so the income statement has a running total, okay, from the cutoff date. So the differences between your equity position at the beginning of the year and the equity position at the end of the year is your net income. Some of these concepts are fairly elementary. We're just laying some groundwork, and I'll get into some concepts that I think will be very useful even if you've done your monthly financial statements, for a long time. So just bear with me on the concepts that are elementary if you're very familiar with them. So we're going to talk about your beginning equity and how it ties to your ending equity. And so your beginning equity is the difference in your assets and liabilities. So at the beginning of the year you had assets and you had liabilities, and the difference was your equity. At the end of the year you have certain assets and liabilities, and the difference is your ending equity. And the difference can be substantiated through your income statement by your net income, and then if you had any distributions, you'd have to factor that out. But your position will change. The change in your position, your equity position at the beginning of the end of the year, is basically your net income less your distributions. There can be other changes that are obscure, like capital contributions and that kind of thing, but generally this is what we're looking at. And S corporations have dividends, C corporations don't. For the most part, everyone's closely held, not a publicly traded company, so we won't talk about dividends on C corporations outside of that. Okay, so you have a set of work papers that support your equity position at the beginning of the year. You have a set of work papers that support the equity position at the end of the year. Okay, and so the difference will be your net income. So you can back into your net income by taking the difference between those two and factoring in any dividends. So if you look at your income statement, you can prove what you made by your change in equity position. So like, let's say you're a cash basis taxpayer. Your equity position at the end of the year on a cash basis versus the equity position at the beginning of the year on a cash basis will prove your taxable income. So in practicing in public accounting, sometimes we would pick up clients, and the client would say, I paid taxes and I didn't make any money, and this is really hard on us, and it's really frustrating. And in some cases, we would actually find that their tax returns were wrong by doing this analysis. So we'd basically quickly put together their cash basis equity position, because you'd factor out your receivables and payables and other items for the beginning and end of the year, and you'd take into consideration their distributions, and it would become pretty quickly, you'd get to a conclusion that it was either fairly stated or you needed to do more work because it didn't look right. And we did pick up clients occasionally that would not have those reconciliations done. And so anyway, let's go through a couple more concepts. Okay, so an index. So on your monthly financial statements, you'll want to have an index. All right, and in your like in your help screens, we produce sample indexes, and you can go to the help screens and you can go to contents, and you can say like there. I'm not sure if we're going to get an index in there. I know if you go, well, let's go to the same thing. If we go to work papers, there are some example indexes in here. If you go to if you go help and release notes, and you do the user guide. We have the 2012, by the way, too. I'm not sure why we haven't put it on this website. In 2012, this becomes our TimeSuite Toolbox user guide. We changed it from conference to guide, so it actually becomes our manual. But there are, there's some sample sets of work papers and stuff like that in here, and you can search for it, that kind of thing. So all right. One thing that we want to do here, this is I'm going to close that because that's last month's. One thing we want to do, if you, on the right-hand side, if you can paste in your email address, I'll share this Google Doc with you so you have access to it. So it has to be a Gmail account. And like I'll share it with Nyman real quick. So this is what we would do. So if you paste your email address in, I'll share that with you. And then you go to google.com and go to your login and go to your drives, and you'll be able to see it. So here's just a sample index. You don't need a very extensive index for your internal financial statements, but here we have cash. We labeled our E work papers as our receivables, G work papers as our prepaids, fixed assets, so on and so forth. And what we're going to do for the most part with the rest of this is we're going to go through and kind of analyze some of these things. We'll have a trial balance, and our trial balance we'll print out, and we'll put our work paper references to the right of our trial balance. So I would do this. I would go here and print a trial balance, maybe print it out and do your referencing on your hard copy is how I would do it. We're doing, the sample date is in January. We're about to switch over to 2013, but we usually do that in late February because of the numbers, the way the numbers display. It makes sense. So you print this out and just put your references next to them. That's what I would recommend. Although you could do a Google Doc every month and do your referencing on this kind of a scenario, which might be a great thing for you actually. So here we have this, and one thing that we did figure out is that you could do some sort of an attachment, but you've got to save that PDF as an image when you download it. So if we say insert an image, then we can do something with that. We'll cover that here in a little while. So anyway, so you could actually use this as your Google Doc, as your monthly financial statements, and you just go through and put your support in here. Pull into this your bank reconciliation image, pull into this your accounts receivable aging, that kind of thing. What I'm going to do is we're going to cover each of these concepts in some detail, but I'm going to cover your G work papers first because that's something that hopefully we can get. Okay, so what we want to do with so we have our trial balance that has our balances on our various accounts. And what we're going to do is we're going to do tested balances on all of our balance sheet accounts for the most part, and we're going to do some analytical procedures on those accounts. We're also going to do analytical procedures on our income statement, and we're going to tie our income statement into our summary of contracts, okay, and do our over-under billings. So our monthly procedures, we would have a checklist, right, for each of these items, and we'd say, okay, complete the bank reconciliation, remove old outstanding checks and or deposits. So we would produce that. We'd have a set of B work papers, and our B work papers, we would basically take the bank reconciliation for each account, and we'd get our old outstanding checks and deposits off the rec. We'd copy the bank statements, and then what I want to do here is I want to figure out if we can store those in this Google Doc so that we've got all that. So we'll do that as we go. So what we'll have is we'll organize our work papers. Like B1 might be our first cash account. All right, B2 might be our second cash account, that kind of thing. So that's how we would, our work on our our cash accounts would be substantiated. It would be supported by work papers. If you had questions on the cash balance 3 months down the line, you could pull out your work papers and say, see, this is the work I did, and these are the bank reconciliations that were done supporting the balances on that financial statement. So we're going to go over to the G work papers, and in our index, I'm jumping around pretty fast, but would be prepaids, and insurance payable would be part of the prepaids. Is generally how we did it with our CPA firm and the clients we worked with, and I think that's some of the training that we do here does the same thing. So here, the workman's comp is, I want to show you, we're going to talk about how it works in the system, and we're going to talk about the processes you would go through to tie out your workman's comp on a monthly basis, okay? So the pages from the policy that include the base rate and the discounts, premium, and total rate, all right? Typically, the base rates are broken out by workman's comp classification. The classifications are identified with base rates and projected labor, okay? So in addition, okay, so then you would have, we'll need to use the base rates, the amount of the discounts and premiums to compute the effective rate. All right, so you'd print your workman's comp report out that calculates the premium for the period through the cutoff date, and then you'd itemize your payments. And then so the difference between the calculated premium and the payments would be part of your equation. So that would be theoretically what you owe on your current policy. You'd look at your previous policy and determine if any audit liability or prepaid had been paid, the calculated liability, and then that equals your calculated liability at the cutoff date. So here we're doing our numbers. So we're going to print out our workman's comp report, and let's say the workman's comp report shows that we have a liability of $1,389.21, just as an example. And so we would come over here to workman's comp, and we'd print one of these reports, and we'd say, okay, let's say our policy started on 01, let's say 01/01/12, and it's going to, our cutoff date is 1/31/12. Preview the report. It tells us that our workman's comp premium is $1,364.21. Okay, so let's put that in, $1,364.21. And then we'd itemize our payments on the policy. So we come over here to our vendor, and in Colorado we have a vendor called Pinnacle Insurance, and we look at our payments, right? And we might say all payments, we might check for cash payments, but here we had one payment on 1/25, and it was for $2,750. So there's our payment. We might itemize that out if we had multiple payments. And so basically the difference is that we've incurred costs, we have payments on that policy, and we would see that. Okay, so maybe we say identify from the end of your last policy through the cutoff date, or another way to say it is for the beginning of the current policy, right? So we said our policy period was, identify the policy period, we're going to say 1/1/2012, 2/1/12/31/2012, okay, just as an example. And we pulled our payment, we pulled our calculated liability, and we pulled our payments, and we said, okay, we should have a prepaid of $1,385, and then we looked at our previous policy. Let's say they did the audit for the policy period ended 12/31/2011, and they said that we owed them $5,899. And maybe you verified their numbers, maybe your CPA verified their numbers to make sure they did it right. And so then you basically, and here we're saying we have a prepaid, okay, because it's a positive number. And so the calculated liability is a prepaid of $45.18, and you would expect your trial balance to say that, okay? So maybe it said $45.38.21. But let's look at the trial balance. Let's see what it does say. And it says prepaid $1,700. We're really looking for the workman's comp here, $45.13.21. So it was $45.13.21. Okay, so that was perfect, right? So that's what we ended up owing. If there was a difference in an adjustment, maybe it was a small adjustment, we would do that. Now you would do that. You can do the same thing for your general liability insurance policy. So you do the similar kind of equation as the workman's comp. Or analysis. Also, and that would just be for the general liability and umbrella, okay, because you have other components of your general liability policy. And that's basically your general policy. The umbrella is not always based on labor, but it can be. Now, if you're a general contractor, you're not going to be calculating general liability on labor. You're generally going to do it on your revenue, so you'll have a computation for revenue. Okay. The system is set up to track your workman's comp automatically. When you set up your workman's comp, you're going to have your effective rates here, and we're going to talk about that next and how we come up with these. So, and what it does is it says, okay, for every labor account, these are the expense accounts we're going to hit. Then you'll notice the direct labor account only lets you post into the direct accounts. The indirect labor accounts only let you post into the indirect accounts. And our convention is the 5s are direct, the 6s are indirect, and the 7s are G&A, right? So kind of an industry standard that we follow with our convention. But so we didn't really come up with that. That's somewhat of an industry standard. And so here for each labor account, we have where the workman's comp goes. So every time you generate a paycheck, it actually posts into those accounts. It calculates the workman's comp, and it posts the workman's comp into the workman's comp expense accounts. So for every paycheck, it'll post one number into your expense here, and for direct labor, and then it credits your liability, which should be here. So every time a check is posted, it does that. So now the next thing is when it does post that check, when you post your payroll check, you've done your accrual. So the one thing that we see sometimes is that the payments will be posted into the workman's comp expense instead of into the liability, so the liability just grows and grows and grows. So when you post the payment, the reason that we tied out in our trial balance to our analysis is because the liability hit this account and the payment hit this account, and so therefore we're going to come in okay. And the audit liability here, we're saying, was adjusted at the end of the year, and that's why it was that much at the end of the year. Okay, so on your workman's comp policies, or on your general liability insurance policies, you would do some sort of analysis. So like for, let's say, an auto, so you would have total premium, months, the insurance companies are typically going to try to get you to prepay. So whether it's prepaid or liability, same concept, okay? So let's say in our analysis, our total premium was, let's say we had a $20,000 premium. Divided by 12 months, it's going to be $1,667 a month. And so then let's say we had payments on that policy. We'd go over to the general ledger vendor. We'd find the vendor that we have our general liability insurance policy with, and we would check the payments, our general liability, our general business policy, I guess you'd say. And let's say the payments on just related to the vehicle was that, and so then we would have that kind of situation. And the thing that you might do is you might do this, the auto, property. You might have other components that you can do this with. And then over here you might do total. So then after you calculate your liability, you put balance per general ledger, and then the difference, and then you do a journal entry for the difference. Debiting expense, and crediting liability. Now, let's talk about our support. I think a lot of you have probably talked to Judy now. She came on, I don't know, a month ago, 2 months ago maybe. And she was a controller for one of our clients, and she's very well versed. She's actually somewhat technical on the computer side too, so she's really a good match for us. And she's exceptional with respect to a lot of the concepts in the system. And we just hired another person for support. And now our format on our so we have basically a first tier support concept where you call in and talk to Alex, basically. Kendra, Alex replaces Kendra, she just left. And then, or you can call the second tier support like Judy and Janine just is starting. Now Judy didn't do a lot of the monthly financial statements like the over under billings and stuff like that. Although she did it some, she didn't do it a ton. But Janine, the new person that's coming in, has done that. And so our format with our you know, like you guys are familiar with Kevin, I'm sure, and some of you have used Kevin to write reports and to do technical things for you. But Kevin's an accountant. He's also, you know, like a computer programmer type of guy. He's a developer for us, and he does special projects. And so I know, like Roberto, who's in the webinar here, he's had Kevin do, you know, a lot of different type things with Crystal reports and other features in the system. And so that's our format with our consultants. And so we have Judy, she's helping some companies as kind of like a part-time CFO person to do some of these concepts, like make sure the insurance policies are in place, make sure the effective rates are in place, help with, just help with some of the concepts that go with our system to try to utilize it better. So she's got, we're trying to get her to get users to use her on a regular basis for some of those things. I know a couple of users are using her to do bank reconciliations and things like that. And then Janine is a similar kind of person where the customers can use her as a resource, and they're not really, they can bill through our company if they want to, through TimeSuite Toolbox, or they can bill directly. And it's, we even give Kevin that option. He can bill them directly or he can bill through us. But they basically, our business model, with the downturn in the economy and the way we've changed the way we do business, and our business model is basically to pass through whatever they generate to them. So they're motivated to service our customers and be a resource for our customers. And whether like Judy, I know she charges a different rate for bookkeeping type services like bank recs than she would do for training and different things like that. But you can negotiate their rate with them and that kind of thing. Janine, my whole point here is Janine has tons of experience with the monthly financial statements. And if you want somebody to kind of get you going and beyond this, maybe you're close in this webinar, kind of get you there. Maybe you want some support. She's done it every month for the last 5 years. That's what she told me the other day. So so she starts actually next Tuesday or Wednesday, and so I think good things are happening with us with our resources and the way we're doing things. Janine will be on the support lines as well, and just like Judy is. So, but our format going forward will be to have consultants and have them do a portion of their time on the support lines, but also be a resource for our customers, that kind of thing. So outsourcing certain concepts sometimes is cost effective, and also for them to be able to provide training. And our cells have picked up, and so they're also going to be training on our new installations. So this is the computation for the insurances. You know, you'd obviously be doing it. You might have for your auto and property, you might have a separate prepaid or liability account for them and for those accounts, and then you'd probably have a separate account for your general liability insurance, and then you probably have a separate account for your workman's comp. Now, the one thing that we talked about is your base rates and your effective rates, and some of you are real familiar with that. There's some real good shortcuts on calculating those, and I think somewhere in here, hopefully we've got some of those kind of laid out. If not, we'll have to lay them out. So okay, so I'm not going to be able to see them in here, so let's do this. Okay, so let's give an example of a base rate computation. Okay, so effective rate computations. So on your policy itself, you'll have a classification, and you'll have maybe a class description, and then you'll have a base rate, and then you'll have like estimated labor. And they might call it estimated premium labor, have different terminology, that kind of thing. And so then you might also have a computed base rate, or computed amounts, right? So let's look at let's correlate this to our demo data. We come over here to our workman's comp. So with some of the other areas, what we'll do is we'll cover some of the lead sheets that you might use in your analysis, that kind of thing as well. So we're going to go to the workman's comp, and we're going to say, you know, here we have a classification of 5213. So we might have a class of 5213, and we are calling that concrete construction. And then we're saying, in addition, we have 5121. And 5506, and 6216, and 8742, and 8810. Okay, and so you fill in all these classifications, and then they might have a base rate, right? So here we have, we'll just go ahead and say, let's say these are our base rates, 15, 10, 11, 12.5, and 0.2. And then let's say they think we're going to have, you know, 200,000 in labor here. And by the way, your general liability insurance will be very similar. The difference between the two policies, that's just if you're a subcontractor, the difference in the two policies is the rates are generally per 100 on workman's comp. And on general liability insurance, they'll be per 1,000. So you have to do that jog on your computations. So then we have okay, so then they'll have like discounts, several discounts maybe in premiums. So discount adjustments and premium adjustments. So let's say they have a 10% here and 5% here, and then let's say they have a 7% here. Okay, so then we're going to say plus that times that will usually have some sort of subtotal plus that times that. Okay, so then we're going to have a premium adjustment, so we're going to add. So the problem with this is calculating each rate through this stream of premiums and discounts is arduous. So there's a quick shortcut that we can do. So go through that. Okay. Okay, so we have that, and then we have, so then what we would do is we would calculate our modifier, and we would say, and basically that would be the 52,833, and then that would be divided by the 57,750. And that gives, so then if we multiply each of these rates by our multiplier, then we'll give it our effective rate. Oops. So the multiplier will do this. And that gives us our effective rate. So then if we accrue at this rate, then we're going to come up with the correct amount that we're going to owe rather than, because the base rate's not right, we're not going to pay 15%. We're going to pay 13% because we have these modifiers. So 13.772 would be what we would bolt in here. And you cross over your 13.772%, okay? So when, and this allows for 5 decimals, which is good. 77286. So then when you run your report over here on your workman's comp, it's going to do it at that effective rate. And these 13.77229 here. Now we're going to have a different amount here, and we owe 1340.61. So when we come up here and we do that with everything, we'll have a different number, negative 1340.61, and then you would have, whoops, didn't want to do that, 1340.61, 1340.61. Okay, so we end up with that. And so we compare our calculated liability compared to the general ledger at the cutoff date. So calculated liability, and then this is our adjustment here. We're going to debit and credit something. Okay, so we think the general ledger shows this amount, right? So what did the trial balance say on workman's comp? It said 4513.21. Oops, 4513.21. So we have a $23.60 adjustment. And so that's our journal entry. And then this is our support. Somebody says, what was your liability? You'll see this on your balance sheet 3 months from now, and you say, well, was that right? And you'll say, yeah, well, we did this, so this is our analysis. So you can print this out and show it to them and support your work. Support your conclusion that your financial statements are reasonable and accurate. Any questions on the workman's comp concepts and insurance concepts? Okay, so let's go to the cash accounts. Bank reconciliation, pretty standard. You're going to have a set of work papers for each cash account, including bank reconciliations. You're going to do your work to make sure that everything on the bank reconciliation is reasonable and accurate. We go over to our e-work papers, and this is the work you should print or generate, and then you put your aging in behind it. Under AR5, print AR aging to GL reconciliation, and then you would use your beginning of the year AR, I'll just print this real quick, aging to GL reconciliation. Now, it's exactly the same report in the AP menu, and you have to pick what you want, AR, AP. Sometimes that throws people off. You would say the end of your previous fiscal year, okay? And then you say the end So the end of the previous fiscal year and the end of your cutoff date. And it gives you a balance for your trial balance, a balance for your aging, the beginning of the year, and at the end of the year. Any differences between here, if this difference is the same as this, there would be no differences in the current period. If there's 0 there and something there, you would expect something to be in here. Okay, so we're trying to, we can go out and try to locate the transactions that got you out of sync. If you ever have a difference here, do a support call and I'll run that down for you. So every time somebody calls with this problem where they have an unexplained difference, we run it down and it helps the entire customer base. Okay, so don't hesitate to call. These are blue numbers, which mean they're on-demand sub-reports, so there's your trial balance if you want to look at it, and here's your aging if you want to look at it. Okay. Okay, so then there's our lead sheet, our work papers, and then our test of balances would be verify that the aging's tied to your trial balance. Here we're verifying the tie because the difference is 0 and 0. So your aging, your trial balance, your aging, and the analysis is somewhat done for you. And then you say verify everything on the aging makes sense and is accurate. So here you have all your items on your aging. Look in your old items and make sure that they're reasonable. And if they're not reasonable, let's say you expect to collect a percentage of them, then you sort of allowance for doubtful accounts on your seeing that and what's not. Okay. Bad debt expense as adjustments to your customer, and you got back into a wall and caused some damages, and so they back charge you, didn't pay you all year amount, so you got to get that off the books. And the back charge should be adjusted through collect the money, or they're not going to pay you, and it's not worth fighting them for the money, and you really didn't earn it, I guess, then you would go through bad debt expense. Bad debt expense looks bad on your income statement. That's why you might want to make sure that your contract adjustments are not run through bad debt expense. The analysis from the bankers and the bonding company are a little harsh on that. So getting an accounts receivable invoice off the books. So when you do, instead of doing a journal entry, you would do like a negative AR invoice and then do a zero receipt to clear them off the books, and you can do support calls on that kind of stuff. So we're back over here. So that's the concept with E was the accounts receivable, in the accounts payable. Basically exactly the same thing. On your accounts payable, you can do substantive testing. For example, you can, for your making sure everything makes sense, you can tie your open items into your open invoice file, trace your subsequent disbursements into your payables. That's what your auditors will generally do, one of the steps they can do to make sure everything makes sense. So old items on your agings you should get off too, so that because just because they tie into the trial balance doesn't mean they're accurate. Everything on the aging has to be reasonable. Okay, so let's go over to our trial balance. We talked about our cash accounts, our fixed assets. Usually we're going to do a depreciation schedule. More and more of our clients are doing the depreciation through here on their book depreciation. We did go through and revamp the logic on this, and if you have any issues with, we do a release on the fixed assets. So the fixed asset depreciation, you set up your assets, and then you would say accrue depreciation monthly, okay? Now, the year-end depreciation, it used to mean something different than the newest revamp of fixed assets, so we just went through it. The year-end, the monthly, what it does is it just takes the monthly amount and accrues it. Okay, the year-end, what it does is it says, okay, how much depreciation have you recorded? How much should have you recorded? And it takes the difference. And okay, what it used to do versus what it does now. It used to take and roll the accumulated depreciation up through this number. And now, what it now means, once you do the patch, is that this accumulated depreciation is your beginning balance when you start them, or when it was last posted in the older format. Okay, so it'll calculate the depreciation that's hit the system, and it'll factor this in as an adjustment. Okay, so this is your beginning of your system depreciation now, where it used to be mean a little bit different, something a little different. And the latest revamp is going to allow us to do additional depreciation methods and stuff like that as we move forward for people's tax methods if they want to do that. So insurance payable versus prepaid, we did that. Those were our G-Work papers. And then also our G-Work papers on the workman's comp. So accounts receivable, we talked about that. Payables, we talked about that. Payroll tax liabilities is something that general is not always addressed and should be addressed. On our trial balance, we'll have like our 941 liability. Typically, there's some sort of analysis that people will do on it. Usually you're figuring out what you owed at the end of the month and then making sure that that's what you really owed. Let's say, your 941, if you're paying every week, did your payment hit after the end of the month for the payroll that was cut through the end of the month? Well, that should be zeroing out most of the time. Your state unemployment, it should be easy to do. You would do a similar analysis to your workman's comp. You'd print your unemployment taxes, your unemployment insurance report for the period. And then you'd compare you would just make sure you paid your previous quarter, and if your previous quarter had been paid, then this would be your liability, basically, right here. Compare that with your general ledger and do a journal entry and print this out, right? So you have substantiation. So let's do this. Let's see what we can do with this. Just put it in the root directory of that folder. Okay, so we're going to come over here. And we're going to try to attach that image. It's not what we wanted.
Harley.
So we can upload, choose an image to upload. Okay, I thought we put that root directory. Let's try it again. HTML sudo. It's right there this time. We're in the twilight zone. Nothing's working. Let's see. Said it was not a valid image, so we'll dismiss it. Let's see if we can convert it to an image.
Everything.
Let's see what
All right.
with this. Anyway, the concept is we can actually convert it to an image if we get the right tool up here. I don't know if I want to spend too much time on it. So once we convert it to an image, then we can upload it into this Google Doc, and then that can provide us with the support we need to substantiate our numbers. So whether it's the trial balance or your agings, insert it into the Google Doc as an image, and then you've got not only do you have your group for the month, but you've got all your supporting work papers. Okay, so if you have problems with that, let me know and I'll help you. So we did let's go back to our index. Okay, so our accrued wages, you would do your accrued wages report, and you can do that through this area. There's your accrued payroll, or you can do it through here. When you generate your accrual, you can tell it to post and preview. This is important to do as part of your monthly process because it accrues all your burdens perfectly. Accruing payroll would be a massive job to do it by hand manually, and I didn't like that too much. So the system goes through it and it perfectly accrues it, so that's the perfect thing to automate. Let's look at the accrued wages over here. So our accrued wages on our O item says labor worked in 1 month is paid in the next month. That's what accrued we're going to accrue on it. And the reason is to accrue the liability to sync the job cost up with the general ledger. Okay, that's the biggest reason. Although you take the liability on your books, the automated accrual is under utilities, accrue wages, post and preview. And then to print without accruing would be under the GL number 7, print analysis reports, and then number 4, print accrual. So let's go back into the system. We're going to spend our time, most of the rest of our time, on the summary contracts. Okay. So if you have questions on the accrual, you can do a support call to figure that out. So here we have our income statement. We're going to print that out. Okay, so here we have on our summary contracts, we have our small job schedule that comes up first. And then we have our completed jobs and our open jobs. In our open jobs, we have our over under billings calculated. So we're going to we'll cover some fairly elementary concepts for some of you that are not familiar with it. So let's talk about what over under billings is. Let's talk about the balance sheet and how it reflects on that as well. So here's our monthly financial statement, January 2012. And what we've done to make sure that our equity position is fair, right? And if we make sure our equity position is fair at the beginning of the year and at the end of the period, beginning of the year would have been 12/31/2011, end of the period would be 1/31/2012, then our net income is fair. Remember, the difference in your equity position from the beginning of the year to the end of the period is going to be your net income. So by substantiating our balance sheet at the beginning of the year, which we would have had done by our CPAs, and then at the end of the period by you've basically proven your net income. Okay, so now you've gone through and you've done agings here, you've done analysis on all your liabilities to make sure they're fair, done adjustments where necessary, you've done work on your workman's comp policies, and maybe any other liabilities. Notes payable would be another concept where you'd want to tie it into your amortization schedules. And I think we have a little bit of work on that here. Work papers. So on your work papers, you might do some sort of lead sheet that looks like this. By the way, if you are going to use this as you'd want to copy this and make yourself the owner and not use this one. I think when we share this, yeah, I'll make it toward, let me just paste in some of your email addresses real quick just to show you before we forget. Okay, so we got everybody on there, hopefully, and if you didn't get on there, go ahead and paste it in. I'll go back and check it one more time, and then call me if you don't get on there, and I can get you on there. So here's an analysis of your beginning balance, your total payments, your interest, and your calculated ending balance, that kind of thing. And you should tie this into your amortization schedules and or your bank statements that you get from the bank on your loans or your financing company. And then you tie these into your general ledger, trial balance, and supporting those numbers. Okay, there's your note payable balances. Okay, so now we've done everything generally that you'll come up against except for the over-under billings. Okay, so what are over-under billings? If you take an accounting class, Principles of Accounting 1, first accounting class in college, probably the first week they tell you about this concept called the matching principle. And then what the matching principle is if I send an invoice out and my related costs are not in there, you're not matching. If I have costs but I don't send the invoice out, then I'm not matching. If I incur costs and I bill it, then I'm matching. Okay. With a construction project, let's look at this Parker job. We have, as of January 31st is our cutoff amount, $96,000, and we have our cost to date, $27,000. And we've got some estimated cost to complete and a total estimated cost, and we expect to make that much money on the job. And right now we're 34% done, the 27 divided by the 96. So we're 34% into this project, and we look at what we billed on the job, and we billed 0. So not uncommon, started the job, maybe at the last week of the month, and we weren't able to bill it. So we incurred a bunch of costs, but no billing. So the question is, do you match? Do you adhere to the matching principle? And the answer is no, because I have $27,000 in cost. I've got a 16% margin that I think I'm going to make on the job. And so then what you do with this schedule is you calculate your margin. So 16% of my $15,000 margin is $5,300. No, 34% of my 16% margin is $5,300. My cost plus my margin gives me my cost plus gross profit. So my cost is in here. My billing is not in here. If I were to calculate my billing, it would be plus my margin, right? So my billing should be $33,000 if this is accurate. If I say this is $30,000, I'm going to come up with a $38,000 under billing and put that in my revenue account. So it's important for this to be conservative so that you're not overstating your financials, but not too conservative so you're not completely off either. So here we have 33. We've earned 33 based on the 16% margin. We've billed 0, so we're underbilled $33,000. So when we go over here to accrue our over-under billing, that's exactly what it's going to do. It's going to take the total of these numbers, and it's going to put it in your asset section. So let's go through and do this. So now the 151,263 is here. The 6658 is here, and the difference is that. Typically, when you're underbilled a substantial amount, that's not always good. So you kind of want to figure out if that's fair. Okay, and that's a different conversation. But we have our over-under billings, and we say post it, and so it posts our over-under billings. It does our accrual and our reversing entry, and it basically puts this asset on the books and put this liability on the books. So when we come over here to our balance sheet, when we hit the lightning bolt and refresh it, it's going to say 151,263, 151,263, and 6658. So now, by accruing the over-under billings, for every open job in total, we're trying to adhere to the matching principle. So then if we look at our revenue, our cost plus gross profit, these are our job-to-date numbers, less the previous year numbers that carried into the current year will give us the number for this year. And we're off a little bit on this demo data. I'm not sure what's going on here, but anyway, so that's, you're generally not going to get off, and you can do a support call if you do get off. So the 118,339 is perfect. That is something I was probably doing some testing on this database or something and goofed it up. But here is basically how you tie in. Now in the help screens, contents, there is some information on it. And I like to refer to the user guide that we do in the conference because I'm a lot more familiar with how to get around in it. But sample summary contract. So here's a sample summary contract. So if you print this out, it kind of shows you how everything ties together. This is the 2007, 2006, so current year, prior year. They do tie together. There's numbers, and we cover this in the user conference in a little more detail. But there's a balance sheet and an income statement sample, too, that kind of goes with this. In the user guide, they're all kind of right next to each other, so it's easy to see. And in that cost control webinar, we actually ask you to print it out and study it. So anyway, the over-under billings are substantiated here and tied into your income statement with your total revenue and total cost. And the significance is when you do a full summary of contracts, not just to your over-under billings, you tie to the income statement. If you just do an open job schedule, which is what most of our competitors have you do, unless you do it in Excel, is it doesn't really tie to the income statement, so you really don't know if you tie in or how accurate it is. You could be off and not know it. Your indirect costs are proven if you tie into your summary contracts, because your summary of contract, your direct cost includes an indirect cost allocation, and your indirect cost allocations show up at the bottom of your income indirect cost section. So your over-under allocation of indirect costs is always known, and that we cover that in depth in the cost control webinar. So if you're not familiar with these concepts, cover that. Go do that webinar. I think it's really good for concepts, lots of concepts. So anyway, so now you've supported your balance sheet and your income statement, and you've got, as far as your total costs are concerned, the cost control webinar also talks about different classifications between direct, indirect, and G&A, and what's proper there, and what's considered, generally accepted accounting principles, that kind of thing. So by having your summary contracts and tying in quickly into your income statement, then you're able to go through and analyze these jobs and make sure they're reasonable as far as their margins are concerned. And that's really what you want to do with your month end, your time on your month end. You don't want to be generating this schedule. And it seems like recently I've talked to 3 or 4 accounts where they'll say, yeah, we generate that schedule outside of the system, and the system is extremely strong with respect to this concept. If you're doing that, you're spending a lot of time that's, in my opinion, unnecessary. The system has a lot of flexibility in how you project those margins. Here you can override your summary contract. So let's say that the margin on this job, it's the 1107 job, which is the third one down, is 11, instead of 11.3, we think it's going to be 15% now. So we can just force it, refresh the report. Now it's 15%, and recalculate my over-under billings. See the 153.074 and post it. So now you've run a change through your summary contracts and your financial statements in a matter of seconds, where that would take a while if you were doing it by hand. For some reason, we're tying in perfectly now. Maybe I didn't refresh the report before, so the revenue does tie in perfectly. And you should expect that to happen. I know I've looked at a couple of companies' numbers recently where their job costs don't tie out, and there's a few things, and in both of those situations they had direct job. They were posting into their direct non-job expense accounts, and those are set up for the labor burden only. And when people post into it, it'll get their job cost off. In that cost control webinar, we cover that concept. So there are ways to quickly find why you're off, okay, including if it's relating to the prior year summary contracts and how it ties into the current year. We have worksheets for that. The mechanics of the over-under billings and getting everything to tie from year to year and perfectly into your income statement, it's sophisticated. It's a sophisticated concept, and we've made it simple, but you still have to do certain things to make it work right. And those things, there's no way to automate. Like, these are the numbers that come from your CPA, the gross profit recognized in the prior year. They come from your CPA firm. Your CPA firm has to give that to you with your auditor to review financial statements. And they should be in the back of your auditor to review financial statements. Now, if you gave it to them and they looked it over and it was good, they may be the same numbers you provided. A lot of times the CPAs will perfectly allocate your indirect costs in. There are ways to do that in our system. By the way, we did automate you used to have to go into ISQL to perfectly burden your indirect costs. That's in the burden utility grid now, so that's a feature that's new. And if you want to do that, just call one of us and we'll walk you through that. Getting this perfectly allocated at the end of the year, that's one thing I would do if I were you guys. You have to have your depreciation done, and you have to have your, your analysis, make sure everything in here should be in here, and then your workman's comp liabilities need to be, and general liability insurance accruals need to be done before you do that, because they usually affect those sections. But that's what we would do. Now, another concept is a time and material job. So let's say the job is a time and material job. So we go into the golden job and we say, calculate contract amount at cost plus markup. That's what we do for time and material. Your time and material, you put your markups over here into the scales tab, whether the designation scales or otherwise. And we do have a lot of features here that people are not familiar with on how you can mark up jobs. So if you're not seeing it, make sure you do a call and we'll help you. So now we've marked that job, time and material. And so when we refresh it, you'll notice that I didn't say OK on that. So go back over here, time and material, click OK, refresh the job or summary contracts, and now it comes in at the cost was 36. The markup is calculating the markup on that 36 because every row has a markup. If you go into the job again and you go to your cost plus, this .NET grid will really give you a lot better detail than this screen will, but I'll click refresh here so you can see it. So your work in process is your marked up cost. Okay, so 85,000 overall, 63,000. This can be a little misleading because if you had accrued wages, it's going to do it. This area doesn't pull in the accrued wages correctly. So let's see, it'll do it based on check date rather than the work date, but I think I can give you an example. So 0101, let's say 01 and then 1231, actually 013112, and I click refresh and it's saying 41,000 is my work in process, which is not what is coming up in here because we have probably wages that were paid. So this screen doesn't, this is basically by the check date. It doesn't discriminate on the work date on the labor. That's why it wouldn't come up. But the .NET grid is a little more sophisticated. So this one would tie in if it pulled those costs correctly based on that filter, but it's doing it by check date rather than work date. So here we had $53,000 in work in process because we had some accrued wages, essentially, is what it's saying. So then it's going to calculate my cost plus gross profit, compare it to my billing, and then there's my over under billings now. So if I can quickly reaccrue my over under billings and tie in. So the time and material cost plus jobs, the system does an exceptional job with them. And then that's an area that can be complicated to try to tie out your over under billings on a time and material job. You always, and the one comment I always hear from customers is we bill everything through the end of the month. We never have any over under billings. And then you calculate it, and then there's over under billings, and then you have to run down what didn't get billed. And that's fairly easy through that new time and material job. So you identify maybe something came in on the 30th of the month. You sent an invoice out on the 31st. Let's say it came in on the 2nd, but it was dated the 30th. You sent the invoice out on the 1st, but the next day another invoice came in, so you put it in, and you put it in the cutoff date, and so then you would have under billings. So it's easy to get over under billings on your time and material job. And let's say it was a $30,000 invoice. Well, you could have a substantial underbilling. Okay, so that was another way to do that, and the way that we're doing it in the cost control webinars, if you have a larger project, you'd use the job status, do your projections on that on a line item by line item basis, and then you know, whether here we were doing it by labor based on this dashboard report. Go to that golden job, go to projected, click on that, gives us our labor hour status, and you go to the field guys or the project managers, and they put in the percent that they actually are done, and it drives your summary contract. So let's say they said it's 10 and 30% there. You would come over here to this, and you would say 10, 30. Hit save here. Come back over here, hit your lightning bolt. by the way, that while that refreshes, it changed our estimated cost to complete. We'll change it by another 1,000, so you can see it's a 216 is our total estimated cost, which includes the adjusted numbers because our field guys say they were 30% done on that labor. So if you have labor, if you're self-performing GC or you're a sub, you would have the labor projections. The other projections you could, non-labor, or the project managers are going to do those projections saying, yeah, we're coming in on budget or we're over budget, and so overall here we have a job that's 233 revised budget, total estimated cost of 216. One thing that I asked somebody yesterday, how do you track your jobs? How do you make adjustments to your jobs on your summary contracts? And she said, we change our budget, which is a terrible thing to do because you want to preserve your budget so you can compare it with what you actually did and have that variance analysis. So budget actual variance becomes less useful if you're adjusting your budget to drive your summary contracts. Instead, you should be doing this job status, which is just in addition to your budget, an additional number beyond the revised budget that you're changing. We just did a feature where we're providing an audit trail on this too, by the way, for who makes those changes to this and when they're changed. So so you know, we do have an audit trail on changes to your job status. Now, one thing that, I wanted to quickly cover that just so that you could see it. We cover that in depth in the cost control webinar, again, on those concepts. But now we've gone to the job status and we've said on a line item by line item basis, we're at 216. I'm going to go to my summary of contracts and I'm going to redo my parameters because I have to tell it, I have to set a parameter different when I do that. And in my budget method, I say job status. The next time we redo this, the job status will be the default, because if the job status is not modified, it's always equal to the budget. So if you don't do it, it's going to come out the same. So now we had a job that was, we have to tell the job. It's not a time and material job anymore. So now we refresh the report, and you'll notice that the total estimated cost of 216,856 has been adjusted to the 216,856. So now our field guys and our project managers are driving our total estimated cost, and our over-under billings are done by them. They're going to do it as of job to date. It could be in the middle of February, and we're doing January's in the middle of March, and we're doing February's. Their total estimated cost is what this is driven on, so that, and their contract amounts need to be matching their total estimated cost. So, make sure if those concepts are cohesive. So then we just accrue our over-under billings, and when you do your over-under billings accrual with that concept, you've got to tell it status, or it doesn't calculate it with the job status in mind. So I calculate my 154, 356 is here, 358 I mean, 66, post it, refresh it does our accrual and our reversing entry, refresh our income statement, and we get 220, 465, 220, 465. And then 118 is obviously going to be that number. Okay, lead sheets for the summary contracts would be your summary contracts, but also this lead sheet is a good one that proves this particular report you do from the beginning of your fiscal year, not your period, to 1/31/2012 to the end of your cutoff period, and it prints your jobs, and then it prints your income statement recap, and it breaks the income statement recap by labor, sub, equipment, other, and at the very bottom, it gives you your general ledger versus job cost billing differences. If you print this and this is off, then there's two things that generally happen. You didn't accrue wages properly at the beginning of the year or the end of the period, or you have non-job postings. If posting is into these direct non-job expense accounts, these accounts are set up just for labor burden. If you post into them, your job costs will be off. This report will tell you what exactly went in there, and we do this on a regular basis. We go in there and we have people move those postings out of there, because this will give you like the journal of everything posted into those accounts. Okay. So real simple. If you get non-zeros there, do a support call. I'll help you with it. Help you figure it out. So a major strength of the system would be helping you and supporting you in the over-under billings process. And So those are the concepts with the webinar. The only thing I didn't do that I really wanted to do was get some images tied into this Google Doc so I could show you how to make a Google Doc your set of monthly work papers. And ideally what you would do is you would go to your Google Docs and click your drive and see all your financial statements for every month, or maybe even have a folder for 2012 and see each month there and be able to click on it. We created it and it's right here. So this would be easy to pull up and see your substantiation. So your trial balance might just be what you scanned in as an image. So just to recap, those are the concepts we wanted to cover. And to recap, our monthly financial statement should be something that we're working on to improve the quality of that financial statement and generate a set of working papers that have an index and tick marks into supporting work papers that you print out or you upload into a Google Doc, and that supports your monthly financial statements and improves the overall quality of those financial statements. Each month, in my opinion, you should be spending 2 to 4 hours generating those monthly financial statements so you have a history of it, that kind of thing. And as you get going and doing it again and again and again, that probably can go down to, in some cases, I think people do it in half an hour to an hour. So, but a major component of the quality of those financial statements are the margins on your open jobs. Making sure these are reasonable, making sure you tie in to your income statement here and here, and understanding the summary contracts and understanding that the basic concept behind the summary contracts is the matching principle, the cost plus the margin compared to the billing. So a big job, let's look at this job. We have cost plus the margin, prior year margin plus current year margin, total margins, the 80,000, 90,000. Gives us a cost plus margin compared to our billing, gives us our over-under billing. By the way, your prior year overhead and profit percentage or revenue, this is the end of your previous fiscal year. If you use, one thing we do, if you're doing monthly, you could do a monthly job schedule in your Google Doc that shows where you've come each month as far as tracking from month to month. We're not really preserving that information in the system, so it's hard for us to see what you did month to month. One other concept that we take a lot of support calls on is, I printed the summary contracts today and it has a different over-under billings than it did yesterday, even though the cost to date column is exactly the same and the billings to date column is exactly the same. And the difference is that your contract amount may have changed and your total estimated cost may have changed. And the concept behind over-under billings is to take the latest information and the most accurate information possible in preparing the schedule. So this is a fluid schedule, meaning it changes. It could change every day, so when you do generate and post those over-under billings, make sure you take a PDF of it and upload it into your Google Doc, okay? So you have to take your PDFs, change them to images, and then upload them into Google Doc. Or what you can do is you can do your set of work papers outside of your Google Doc and maybe into a PDF concept, which I was trying to work on a little while ago, and I'm struggling with it. I subscribe to using Adobe, and they just don't have an index in this online solution they have. So I'm not sure that's the best solution. Anybody have any questions? Any more email addresses? Roberto, you have a Gmail, or maybe email the Gmail to me?
Yeah, I have a Gmail, and I can't remember the first part of the address, so I'll send it to you later.
Okay, that sounds good. And then Janine will start next week if you want some direction, if you guys, want some additional help on some of the concepts. Okay, and then you can always call me as well. I think one thing that we haven't done in the past is we haven't really pushed on getting the monthly financials done as much as we should have, and so hopefully we're pushing harder and harder now to get our customers to do it. Now, obviously, whether they do it or not is their deal, but we want to provide the support that we can, and encourage them to do it. You keep your books clean all year long, month in and month out. If somebody needs a financial statement, it's easy to generate, and you have some sort of, assurance that it's done well. I mean, the worst thing in the world is for the bank to call and say, hey, can you get a financial statement? And you produce it, generate your balance sheet and income statement, and you have no work on it. And you say that, and so, I mean, what's your comfort level for it being accurate? I mean, I've seen it done again and again and again by business owners and not necessarily controllers, but smaller business owners that maybe have someone, like an accountant that doesn't really do the tie-outs. The financial statements could be majorly misstated, and you wouldn't know it unless you're doing some sort of analysis on your balances at the end of each month. So you keep your books clean. As your issues come up, you resolve them, and at the end of the year, your audits are very clean. So when we did the CPA firm, from 1990 to 1998, we went from basically scratch to 125 audits and reviews, and we had about 70 to 80% of our clients doing monthly financial statements internally, and that drove a ton of business to us. The bonding companies referred the heck out of us, and our year ends were so incredibly easy and profitable and we were doing it. We could do it for a very competitive price. In a lot of cases, less than our competitors, and they would complain that our prices were too low. Well, our clients' books were incredibly clean, so that's doing the monthly procedure checking, plus tying out your summary contracts every month. They lend very well to everything kind of just falling in place. So anyway, thank you guys. If you have questions, let me know. Email me, or if you have questions now, chime in. So anybody have anything? Okay. Well, I'll let you go. Thank you very much. Talk to you later.
Thank you.
You bet.
Bye.
You bet. Bye.
Bye, Eric.
See ya. Sorry I was late, guys. Bye, Robert.
All right.
Take care.